Okay.
HELOCs, Dave. I know we got a lot to pump through. So I want to. You were showing us before some changes potentially coming for HELOCs,
Yeah,
home equity
those are
lines of credit for listeners who for jargony.
yeah. So a lot of people don't realize that when they have a secured line of credit, a HELOC, a home equity line of credit, a Flex TD Flex line, BMO Ready line, like everyone, all these banks
Manulife
have
one.
different. Yeah, everyone has these different, names for them. They're secured lines of credit. They are a mortgage. A lot of people think or say they, whenever I speak to them, Paul, I'm sure you get this all the time. No, I don't have any mortgage. Like, and then you pull the credit. Well, what's this $300,000 secured line of credit? Oh, well, that's just a secured line of credit. Secured as the house. Well, that's a mortgage. So what has kind of come up that OFC is looking at, who oversees the banking and mortgage industry, and making some changes to HELOCs and really tightening down on them. They don't like how much it's being marketed. They don't like how many people have it. Secured lines of credit or HELOCs, they are revolving in the sense that you can pay them. The limit is opened up again as you pay down the mortgage. It increases your limit. So as you pay your monthly payment, that limit continues to increase. So it gives you automatic access to equity. And so they really don't like that because it leaves a lot of debt or potential debt out there for consumers. There's a lot of arguments to be said. They're saying, this could be used for artificially propping up the economy. This could be used for increasing, purchases in the home market because people are leveraging equity to purchase other property or taking on property in other countries where maybe that debt load becomes too high. Rightly or wrongly, they really want to clamp down on it. They're saying that they are likely next year, and it's basically the superintendent basically said they're going to make significant changes. And really what they're looking at is tightening up, number one, how you qualify, that likely clamping down that it doesn't just increase as you pay down the mortgage. It doesn't automatically increase. And if you want an increase to it, you need to re-qualify, and probably limiting how much you can get access to at a time, things like that. And then on the other side, with mortgages, with secured lines of credit, there are amounts of capital that a bank needs to keep in their reserves when lending. So it's a percentage, for every dollar that they lend out, they need to have X dollars in reserves at that institution. With a HELOC, they're looking at increasing that. So what does that mean? It means that it costs more for the bank to hold those funds, which obviously they'll just pass on to consumers, and which will drive up the interest rates on these as well. So there's a lot of implications with it, but it's something that they are looking at. So those of you that have them, are thinking about getting them, something to consider, or maybe get before they shut them down next year. But something to kind of keep on the radar. Yeah, something to keep on the radar. But banks use it, really seldom on most mortgages, and these are only available for mortgages that are unconventional, meaning that they are more than 20% down. And but banks use them as a marketing tool because they know that the more product you have with a specific bank, the less likely you are to move to another bank. And with a mortgage, when you have a HELOC, the type of registration on the mortgage, you can't just easily transfer your mortgage to another bank. It's collaterally charged. It's a different product. You have to refinance it, meaning that you're incurring an appraisal cost, you're incurring legal fees. So they know that these added fees are going to hold somebody back from moving. So they're not always offering it to you, whether if you don't need it, it's not always wise to get it or take it. They are really just looking to saddle you with that bank or hold you to them and make it more difficult to shop around when your term is up or look at other banks when rates change or lower, things like that.
Yeah, I mean, you made a lot of very valid points there, and I think that is a lot of things that people don't consider. Like you said, if you have an $800,000 HELOC that's at zero, and all of a sudden you decide you're going to run that up and buy 4 properties, certainly changes the optics of the industry as a whole. Or if you take that money and just like you said, they're just, you know, there could be trillions of, well, maybe not trillions, but let's say billions of dollars that are just sitting there waiting to be taken from HELOCs. And then if everyone decides overnight to take them, well, that completely shifts everything. And like I said, it could kind of inflate or make the market look more active than it actually is.
Well, so to that point, so right now, they're saying that there's 737 billion of readvanceable mortgages in Canada. So meaning
$1 trillion. That was pretty close.
Yeah. So $750 billion out there that people have access to this capital. Now, the other argument is, they do sell it based on, if you go through hard times, you have access to this. So there is that argument that it's actually preventing a lot of defaulted mortgages as well, because if somebody loses their job, somebody gets in a cash crunch, that these products are interest only, and they can use that. They can use the equity to make the regular mortgage payment or to make their bill payments, and not be taking it on to credit cards at 19 and 29%, or on unsecured lines of credit that now are in the 9 to 12 and higher percent. So there is that other argument of it, that they can be used in a manner that, if they could be artificially propping up somebody's financial picture, but that's better than them going to the the unregulated credit card and unsecured market that nobody that they don't really talk about much or care about.
Oh, the capital-based visa companies.
Yeah.
I mean, I have clients that are putting 5% down sometimes. That are like, can we get a line of credit too on the mortgage? So Dave, you mentioned that point that, like, on these lines of credit, you can't go above that 80%, and actually only 65% of the total mortgages on the property can be a HELOC. So it's not like if you're putting 10% down, you can then get a HELOC that starts from that point on your 11% equity doesn't give you access to your HELOC. You have to have more than at least 20% equity in the property to even qualify to have that product. So there is a bit of a buffer built in there to avoid that default where people are borrowing, 120% of their value because they have that line of credit there. But yeah, so that's a very interesting shift that we'll see. There's going to be a lot of changes. We're going to see a lot of changes in the coming years.
Yeah. Yeah, I think
we're coming into the era of smarter borrowing.
Mm-hmm.
I think people are getting a little bit smarter finally. And I don't know. I just see this whole next 5 years, especially, to be a big shift in what people spend and how they spend it and how lenders look at everything, right? I just think it's time for everyone to be a bit more responsible.
I think no matter what, we've talked about it before, all these changes that we keep talking about, or tightening of lending, things like that, bringing in stress tests or higher stress tests, whatever it may be. There has always been changes to the mortgage industry. There's always been, we've been at higher interest rates than we are now, significantly higher. There's been shifts from that 0% down 40-year amortization, to where we are now of 25-year and 5%. People continue to buy. We have, prices continue to go up. There's still that demand until, it's going to continue to, people are going to continue to want homes as long as Canadians have that obsession with housing. And so that's really us as a mindset, have that obsession with housing, whereas other countries don't. And so people are just going to, they can make, all these changes can come into play, but there's always going to be ways for which people can borrow, leverage that property. If they want to acquire their property, they're going to find a way to do it. So, some of these instances like this tightening up of HELOCs next year, changes to down payment for rentals, things like that, people will just become more creative. And the unfortunate side of it as well is that people will then move to the alternative space. People are still, again, there's that obsession with housing. So instead of going to your traditional A lenders where you're getting it at, best rates and all that, they're moving into the alternative or private space where it's higher interest rates, interest only, or what have you, where, people are still wanting those houses. There's still renters needing a rental property, and there's not enough rentals being built by whether it be the feds or, larger institutions. So kind of clamping down on mom and pop investors owning one rental property, or even if they own 5 rental properties, single unit rental properties, it's, clamping down on those isn't really a big impact to the marketplace, but people are going to continue to want to invest.
Thanks for tuning in, everyone. We hope you enjoyed today's episode. Please remember to like, share, comment, and subscribe because we'd really like that.